In August 1982, Ray Dalio walked onto national television and made the kind of prediction that can destroy a career. He was 33 years old, confident, and convinced the American economy was on the edge of disaster. Debt looked dangerous. Banks looked fragile. The system looked ready to break. Dalio did not whisper his warning in private. He said it in public, with certainty. And then the market did the one thing he was not prepared for. He was wrong. Not slightly wrong, spectacularly wrong. Instead of collapsing into depression, stocks launched into a powerful bull market. Clients pulled their money. His confidence turned into humiliation. Bridgewater was almost wiped out. Dalio had to lay off nearly everyone until the company was reduced to a shell. The man who thought he understood the machine suddenly could not even pay his own bills without help. At the bottom, Dalio had to borrow $4,000 from his father just to support his family. That moment broke something inside him, but it also built the foundation of everything that came later. He realized the most dangerous thing in markets was not ignorance, it was certainty. The disaster taught him that being smart was not enough. If he wanted to survive, he needed a system that could protect him from himself. That is the mystery of Ray Dalio. The same man who nearly destroyed his firm with a wrong prediction later built Bridgewater into the most famous macro hedge fund empire in the world. It would manage enormous institutional money, advise governments, study debt cycles, and become known for a culture unlike anything on Wall Street. But the comeback did not begin with genius. It began with pain. Dalio's first classroom was not Harvard. It was a golf course on Long Island. As a teenager, he worked as a caddie for wealthy investors and listened to them talk about stocks. Most kids heard noise. Dalio heard clues. He learned that money had patterns, that adults were often guessing, and that markets could turn a small decision into a life-changing result. His first stock pick came from a simple filter. He looked for something cheap enough to buy. He found Northeast Airlines, a stock trading under $5. Then it tripled after a merger. To a young Dalio, that felt like discovering a secret door in reality. School had not made him feel brilliant. Markets did. They rewarded curiosity, risk, and pattern recognition. But Dalio was not a perfect student. He struggled with traditional school and disliked memorizing things that felt useless. What pulled him in was cause and effect. Why did prices move? Why did economies boom? Why did debt cycles repeat? He did not want random tips. He wanted the machine underneath the noise. That obsession would become the core of Bridgewater. After college and business school, Dalio entered the world of commodities, currencies, and global macro. This was not the simple world of buying one stock and hoping it went up. It was a world where grain prices, oil shocks, inflation, central banks, exchange rates, and political decisions all collided. Dalio loved it because it looked chaotic, but he believed chaos had rules. In 1975, he founded Bridgewater from a small apartment. There was no giant headquarters, no empire, no mythology, just a young trader, research notes, phone calls, and the belief that markets could be understood as systems. He named the company Bridgewater because he wanted it to connect different worlds, producers and buyers, risk and protection, information and action. Bridgewater's early business was practical. Dalio helped clients understand price risks in commodities and currencies. A company worried about chicken prices, grain prices, or currency moves needed a way to survive uncertainty. Dalio was not yet managing a legendary fund. He was selling clarity. He was trying to show businesses that the future could not be predicted perfectly, but risk could be structured. The deeper Dalio studied markets, the more he saw economies as machines. Income becomes spending. Spending becomes someone else's income. Credit expands, debt grows. Interest rates change behavior. Central banks push and pull. Booms create confidence. Confidence creates excess. And excess eventually creates pain. To Dalio, history did not repeat perfectly, but the mechanics echoed. That belief made his 1982 mistake even more painful. Dalio thought he had read the machine correctly. He saw debt stress and expected collapse. But markets turned, policy shifted, and the outcome moved against him. The lesson was brutal. Even if your model is intelligent, reality can still humiliate you. The world is bigger than any single opinion. After that, Dalio built a rule for survival. Pain plus reflection equals progress. Pain alone was not enough. Plenty of traders lose money and learn nothing. Reflection meant dissecting the failure until the lesson became clear. What assumption was wrong? What signal was ignored? What ego protected the mistake? Bridgewater's future culture would grow from that wound. This is where Bridgewater became strange. Dalio did not just want better research. He wanted a company where bad thinking could be exposed before it damaged decisions. That meant attacking ego directly. Meetings became confrontational. Mistakes became public. Disagreements were not treated as disloyalty. They were treated as data. The goal was not comfort. The goal was truth. Dalio called it radical truth and radical transparency. In theory, it sounded noble. Say what you really think. Show your reasoning. Let the best idea win. But in practice, it could feel harsh, exposing, and uncomfortable. Bridgewater was not designed to protect feelings first. It was designed to pressure test people until their thinking either improved or cracked. Inside Bridgewater, many meetings were recorded. Conversations could be reviewed. Employees were encouraged to challenge each other openly. To supporters, this created an idea meritocracy where truth mattered more than rank. To critics, it felt like surveillance wrapped in philosophy. The same system that made Bridgewater famous also made outsiders wonder what kind of company Dalio had really built. Then came the dot collector, a tool that made Bridgewater's culture even more intense. Employees could rate each other in real time on traits like logic, creativity, reliability, and openness. Little dots became judgments. Judgments became data. Data became profiles. Dalio believed this helped reveal how people really thought. But imagine sitting in a meeting while your co-workers score your mind. That is the paradox of Bridgewater's culture. It was built to remove hidden weakness, but it created new tensions. Some employees found it honest and transformative. Others found it humiliating. Dalio wanted truth without politics. But people are not spreadsheets. They have pride, fear, ambition, insecurity, and status games. Building a machine to understand markets was hard. Building one to understand humans was harder. While outsiders obsessed over the culture, Bridgewater was building something even more important, a decision system. Dalio wanted investment views broken into rules. What happens when growth rises? What happens when inflation falls? What happens when debt expands too far? The goal was to turn judgment into repeatable logic, not because humans were useless, but because humans were biased. This thinking powered Pure Alpha, Bridgewater's flagship strategy. The idea was not to make one heroic bet. It was to create many independent bets across currencies, bonds, commodities, equities, and economies. If one view failed, another could work. Dalio called diversification the closest thing to a free lunch in investing, because uncorrelated bets could reduce risk without killing return. Dalio's famous Holy Grail was not a mystical secret. It was math. If you could find enough good investments that did not move together, the whole portfolio could become stronger than its parts. One bet might lose, another might win. The point was not to be right every time. The point was to build a structure that could survive being wrong. Then came all weather, a strategy built around a simple but powerful question. What portfolio could survive different economic environments? Growth rising, growth falling, inflation rising, inflation falling. Instead of betting everything on one forecast, all weather tried to balance risks across conditions. It was a machine built for uncertainty, born from a man who had once been destroyed by certainty. This is why Bridgewater attracted pension funds, governments, endowments, and institutions that cared less about glamour and more about survival. These clients did not want a trader screaming on a desk. They wanted a system. They wanted research, diversification, risk control, and an explanation of what might happen if the world changed. Dalio sold them something rare, a map for uncertainty. Bridgewater's daily research became almost legendary. Its notes explained markets through debt cycles, capital flows, political shifts, and central bank behavior. Dalio was not simply asking which stock was cheap. He was asking how the global machine was moving. That framework helped Bridgewater become valuable to people managing money so large that one mistake could affect retirements, budgets, and national wealth. Then 2008 arrived. The financial system cracked under debt, leverage, housing losses, and broken trust. Many firms were shocked. Dalio was not shocked in the same way. Bridgewater had spent years studying how debt crises unfold. Its systems warned that the machine was under stress. While much of Wall Street was drowning, Bridgewater's reputation grew. The crisis made Dalio look less like a strange philosopher and more like someone who had understood the plumbing. He saw debt cycles as recurring patterns, not isolated disasters. Credit expands, assets rise, borrowers stretch, confidence becomes arrogance, then the cycle reverses. To Dalio, 2008 was not magic. It was the machine doing what machines do when pressure builds too long. Bridgewater became known as the world's largest hedge fund, managing staggering sums for some of the most important institutions on Earth. That scale changed the meaning of the firm. It was no longer just Ray Dalio's investment shop. It was a global financial institution with influence, secrecy, admirers, critics, and a culture people either worshipped or feared. But success created another problem. Dalio became a public guru. He wrote principles, he explained debt cycles, he warned about inequality, populism, China, money printing, and world order shifts. Millions listened because Bridgewater gave him credibility. But the more public he became, the more people compared his big warnings to market reality. And not every warning aged well. That is the ultimate paradox. Dalio, the public forecaster, could be early, wrong, or dramatic. But Bridgewater, the machine, did not depend on one man being perfectly right. The firm's best idea was not trust Ray. It was test everything, turn opinions into rules, compare them against reality, weigh believable people differently. Let the system challenge the founder. That may be Bridgewater's greatest lesson. A strong system can outperform a brilliant ego because it does not need to feel heroic. It can change when evidence changes. It can diversify when certainty is dangerous. It can reduce a person's influence when the data disagrees. Dalio built Bridgewater after being humiliated by certainty, then tried to institutionalize doubt. But systems have weaknesses too. Rules can become rigid. Culture can become ideology. Transparency can become pressure. A company built to defeat human ego can create new forms of ego around the system itself. Bridgewater's critics argued that the firm's culture could be intense, cold, and sometimes dehumanizing. Dalio's supporters argued that truth was supposed to be uncomfortable. This tension made Bridgewater fascinating beyond finance. It asked a question most companies avoid. What if every weakness could be measured? What if every disagreement could be recorded? What if every employee could be scored? Would that produce truth or fear? Would it create better decisions or people trained to perform honesty for the cameras? Dalio eventually stepped back from day-to-day control, handing Bridgewater to the next generation of leaders. That transition mattered because the firm had to prove it was more than its founder. If Bridgewater was truly a system, it should survive without Ray pulling every lever. If it was really a founder-driven empire, succession would reveal the weakness. The market environment also changed. Years of low rates, then inflation shocks, then rapid central bank tightening challenged many investment models. Strategies that worked beautifully in one era could struggle in another. That is the problem with every financial machine. The world keeps changing the inputs, A model can be powerful and still face regimes it was not built for. Still, Dalio's influence is enormous because he gave investors a language, debt cycles, economic machines, radical transparency, principles, diversified bets, all-weather. These ideas escaped Bridgewater and entered mainstream finance. Even people who dislike Dalio often use parts of his framework. That is how you know a thinker mattered, when the vocabulary outlives the debate. The personal story remains almost cinematic. A kid who struggled in school discovers markets through caddying. A young trader builds a firm from an apartment. A confident forecaster humiliates himself on television. A broken founder borrows from his father. Then he rebuilds using the one lesson pain forced into him. Never trust certainty unless reality keeps proving it. For ordinary investors, Dalio's story is not a promise that you can copy Bridgewater. You cannot build a global macro machine from a phone app, but you can copy the deeper habits. Write down your assumptions, diversify intelligently, study cycles, respect risk, learn from pain, and be suspicious of your own confidence. The real enemy is not the market, it is the ego inside the investor. For companies, the lesson is more uncomfortable. Bridgewater shows that truth can be a competitive advantage, but also that truth systems can become brutal if they forget people are human. Radical transparency can expose bad thinking, but it can also expose dignity. The best organizations need honesty. The question is, how much psychological pressure people can survive in the name of better decisions. That is why Ray Dalio's empire is both inspiring and unsettling. He built one of the most powerful hedge funds by turning failure into a system. But the system did not stop at markets. It moved into meetings, relationships, personalities, and judgment. Dalio wanted to master the economic machine. Then he tried to master the human machine too. Ray Dalio did not build Bridgewater because he was always right. He built it because being wrong nearly destroyed him. That is the strange truth behind the world's largest hedge fund story. Its foundation was not confidence, it was humiliation. A public mistake became a private philosophy. A broken trader built a machine to fight ego, uncertainty, and human blindness. And in doing so, he created an empire that still asks one uncomfortable question. What if your biggest failure is the only reason you ever learn the truth? Thanks for watching. Like, comment, and subscribe if you enjoyed the story of how Ray Dalio built the world's largest hedge fund. Then you'll love the story of how Mukesh Ambani built India's biggest business empire. Click the video on your screen now. I'll see you there.